Hey everyone, me Kevin here. By now we already know that the housing market has finally hit a peak and it's already been rotating down nationally to the tune of about 5.5%, and in specific areas as much as 11 to 12% since March to May, when we kind of saw real estate in various different markets peak. Some markets peaked as early as February. And in this video we're going to break down specifically which areas are starting to be affected the most. And what's fascinating is the most common question that I've been getting lately about my real estate startup is, Kevin, where are you going to buy properties? And the answer is, well, we have an idea. We are looking at data just like this to try to understand where the biggest opportunities might actually be coming from. So the reason we're not committing to something yet is because the real estate market is just at the beginning of its decline, but we're already starting to see some big highlighters in certain cities. And that's what we're going to talk about in this video. Keep in mind, generally, and this is very generally speaking, the way you can determine a real estate bottom is the following ways. Number one, inventory, rather than skyrocketing, starts rapidly declining. Right now, we're in the phase of building inventory. So as you see inventory building, you tend to be closer to a top of a market, or maybe in, there could be seasonal effects of the year as well. But generally, when you see inventory go up, you tend to see prices come down. Now, if you see price reductions, the percentage of listings with active price reductions going up, then you tend to also have a sign that you're towards a top of a market rather than the bottom of a market. The opposite happens at the bottom of the market. Bottom of the market, you tend to see price reductions plummet. That is, less price reductions are required to see prices actually go up again or for properties to sell. And then, of course, what this one is a little bit more lagging, you can keep an eye on median home sale prices. The best way to determine a bottom, though, in my opinion, is by actually being in a market regularly. So, for example, with my real estate startup house hack, I'm going to have to be in 3 to 5 markets and be consistently in them, talking to agents every single week about what's going on in the market and visiting those markets throughout the United States. So that way I know, oh, here's a housing tract, and we're seeing 3-bedroom, 2-bath, 1,300 square foot models sell for less, and less every single month. Then we know, okay, we haven't hit the bottom yet. But when we start seeing the leading data, okay, and this is like a big secret, like only somebody in the real estate industry would be able to tell you this, because the reality is there are a lot of people who just sit behind a camera or, sit around at home and don't actually go and physically do anything, and then you wouldn't know this. Real estate is a people business. And when you start seeing the realtors telling you at broker tours or on the phone when you're talking about what's going on, or in person at meetings, hey, we're starting to see more activity. Hey, whoa, instead of properties sitting on the market for 30 days before getting an offer, we're starting to get offers in 20 days or in 10 days or in 2 days after listing. Hey, we're starting to increase our listing prices with sellers, and we're starting to get those. You can get a 3 to 4 month advantage on when the housing market is actually bottoming, because you're actually paying attention to the market significantly better than anybody else is paying attention to the market. I would rather know that pending home sales are going in for higher values at the bottom of the market than wait 3 or 4 months for the National Association of Realtors or Redfin or whatever to give me some kind of sold data. Then you're too late, right? Anyway, this information that we're going to look at here is a form of leading information about the housing market slowing down, and it gives us some insight from home builder Lennar, who has 3 categories of housing market suffering decline. And they just came out on September 22nd, at the end of September 22nd, with a new update in terms of what the heck is going on in the market. So let's go ahead and look at their introduction first, and then we're gonna go into the specific markets. So, intro here. Obviously, we know that housing has now been, quote, considerably impacted by more than the doubling of mortgage rates. We saw this coming. There's a reason I said since January, we got to be careful. Like, housing's about to get destroyed. And everybody thought I was crazy. That no way, supply is way too tight. It'll never go down. Yeah, right. Just buckle up. It not only has it started going down, it's going to continue to go down. My expectation. Now, then we have a note over here that while there is still a housing shortage across the country, and we're not expecting to see a foreclosure or speculator crisis kind of like we did in 2008, where you had a bunch of short sales and foreclosures, we are seeing prices go down and incentives basically being increased. Now, this is really important, and it's part of the psychology that I teach in the programs on building your wealth linked down below. But you got to know this. When a home builder sells a property for $500,000, and then the next home that they finish construction on, it comes up for sale for $490,000. Guess who they just pissed off? They just pissed off the prior buyer, and the prior buyer feels like they got reamed, like they got a bad deal, right? So generally in new construction homes, and we specifically talk about this in the 0 to Millionaire course for real estate investing. There's also a do-it-yourself property management and rental renovations course. So that way, if you're clueless about real estate, you can learn everything from 0 to Millionaire, what it takes to get there, and honestly how relatively easy it actually is. But anyway, if the builder instead, every phase of new construction, see, let's say if this is phase 1, then phase 2, they say, okay, we're gonna sell homes for 510. Then phase 3, we're gonna sell homes for, here we go, we're gonna sell homes for 520. Well, now all of a sudden people are happy because they feel like there's appreciation happening in the neighborhood and that they made the right decision. So that way these people are happy, these people are happy, and these people are happy because those people have historically been happy. So that implies that they should be happy going forward as well, right? Now, when the market goes down, the first thing that builders do is they increase what are known as incentives. So if the market value of this property actually declines to $490,000 because interest rates go up substantially, well then rather than actually providing a $30,000 price reduction, why don't we just give you some incentives and basically convince you to buy the property so that way you can finance this. And we'll just give you $30,000 in builder credits, and we'll put in whatever floor you want. You want the $7 a square foot hardwood floor because you're an idiot and you don't understand anything about investing, you just want to blow your money? No problem, we'll put that in for you. There you go. You got 3,000 square feet. We'll throw this in here for $7 a foot, throw in baseboards, boom, your $30,000 is gone. I know that it's a little crazy, but it is kind of how it goes with the new construction builders. But now all of a sudden somebody's paying $520 for a building. They feel like they're only paying $490, but the sales comp actually shows up at $520. So all these people, guess what, are still happy. And they just think, oh, okay, yeah, you put in expensive flooring. Wow, how pretty, how nice. Your feet really know the difference. No, it's a complete ripoff and it's stupid. Also things, by the way, that I teach in my renovations courses. There's a coupon code, by the way, for those expiring on September 30th. You get private live streams with me as well, where I also do deal analysis and fundamental analysis on real estate and stocks. Okay, let's go back to Lennar over here and see what else they've got for us. And then we're gonna get into those specific markets. One of the big red flags that I'm seeing from Lennar is that on September 22nd, which is not that long ago, they're telling us that now all of a sudden they're being extremely selective on new acquisitions for new communities. This is really bad for the national housing shortage, but it's a way of them basically saying, hey, like our stock is getting cheap to the point where we may as well start evaluating, do we actually want to buy land? Or do we just want to buy back our stock? Now, they're not buying back their stock because instead they're paying off debt. I believe they mentioned that on one of the first pages here that, oh yeah, here it is. After paying down $575 million of maturing debt without replacement, we're fortifying our balance sheet and we're choosing not to repurchase stock. So in other words, they see the writing on the wall, right? Like this is a huge warning sign. Lennar is like, yeah, we're not gonna buy back stock because we're gonna pay down debt because we're worried that things are about to hit the fan and we want to make sure we're insulated. That's a smart thing to do as a company. But over here they tell us, yeah, we're not really buying land right now because we'd rather buy stock. But they're not buying stock because they'd rather pay down debt because they're panicking. So they're definitely not buying land for new developments, right? Like that is a leading red flag. By the way, if you're an accredited investor or not, because we're expecting in January to be able to accept non-accredited investors, there's something I think that's really cool for you to know about HouseHack that we can do, and that's my startup. You can go to househack.com for that. But there are actually 3 ways that you can get wedge deals. Number 1, this is what everybody has access to. If a flipper is flipping homes in your area, you can buy a wedge deal. So you buy a wedge deal below market, right? That is a definition of a wedge deal. For single family, generally, that is a fixer-upper. For multifamily, that's something that's below rent. And then that way the cap rates appear misaligned and you can increase the rents to kind of fix that and increase the value of the property. Anyway, that's your traditional way to get a wedge deal. And those are just 2 ways. There are actually 4 in total, but those are the most common 2 for multifamily and single family. Number two, the second way that my startup can actually get wedge deals is actually what Lennar just said. When we go public, which I expect to go public this decade, I'm really excited about that. I mean, no guarantees, right? But I want to IPO this company. I want to ring the stock market exchange bell, and I want to be able to reward all of the people who are joining House Hack by not taking a dime of compensation until they've at least doubled their money. But not only that, I'll be subject to massive lockups on any kind of comp I get, and I'm not getting paid until we IPO, which is great. But anyway, the next thing that we can do is you can actually get a wedge deal by buying back your stock. And what's really remarkable about that is if you think about it, if you buy a $500,000 house as a wedge deal in a $700,000 neighborhood and you put $50K into it, you get a $150K wedge deal. But now if you have a stock market crash and the value of your entire company that's holding these assets falls below levels where like you're getting it for a discount of book value, say another 15% off of book value, well now all of a sudden you may as well just buy stock back, and you're literally buying that $550K house in a $700,000 neighborhood now for another, say, 10% off. So now $500,000, not even considering the fix up, or $450,000, depending on what the stock market discount is being offered. And so, like, when Lennar says, hey, like, we have the opportunity to buy back our stock, it's actually a really smart thing to do. Like, there are opportunities where you can actually get a wedge deal after a wedge deal after a wedge deal. And then another thing that you can do is you can, as a corporation, as a C corporation, you can kind of what I call roof stock your properties, which is where you could take, like, let's say if you had 1,000 properties, you take like a slice over here, a sliver of maybe 10 or 20% of your properties. You sell these off to a pension fund for a premium, right? So, and that's fair because you've already gotten these properties stabilized or whatever, right? And you maintain the management, some appreciation to the upside, whatever. Maybe it's not necessarily a premium day one, but it's a premium in the end when you take a share of the appreciation. Those are three ways you can actually get wedge deals in real estate. Now, everybody, as a normal person watching, everybody has access to option number one. Only corporations have options, or have the option for number two, and then corporations or partnerships have the option for number three generally. Okay, so this is just all more just education for you. I think it's very important to know. So, what are those actual markets that we want to talk about? Well, here we go. So here are the Category 1 markets. So Category 1 markets have continued to be strong, and we've had to offer mortgage buy-down programs and normalize incentives to maintain sales momentum. So basically, like, even in their strong markets, they're having to give people money to get them to buy the deals and to maintain any kind of semblance of sales momentum. So even though these markets are doing well and they're benefiting from low unemployment and low inventory, they're still having to cut prices and give more incentives in these markets. So these are not immune markets. These are just sort of like the best of the worst. And the best of the worst are Southwest Florida, Southeast Florida, Palm Atlantic, New Jersey, Maryland, Virginia, Charlotte, and Indianapolis, and this is a shocker, San Diego. Oh, wow. All right. Category 2 markets, these reflect more significant adjustments. These include the following: Tampa, Orlando, Jacksonville, Coastal Carolinas, Atlanta, Chicago, Nashville, Raleigh, Dallas, Houston, San Antonio, Phoenix, Tucson, Arizona, Las Vegas, Colorado, Coastal California, that's Mediterranean climate for you, in the south at least, Coastal Carolinas, Inland Empire, Bay Area, Central Valley, Sacramento, Seattle, Portland. Each of these markets have seen traffic slow. We've seen a pileup of cancellation, and while inventory is limited, this is like the most common argument that people make is like, oh, but there's so little inventory. Yeah, all right, we got it. It doesn't mean that you're immune from prices going down. In fact, we've had to offer more aggressive financing programs, reduce prices, and or increase incentives. That's kind of like your flooring thing, right? Now, the third category of markets, these are the ones with a more significant market softening and correction already, include the following: Philly, Minnesota, Pensacola, Austin, Texas, this is a big one, Reno, Boise, Idaho, and Utah. While the drivers and individual dynamics of these markets are somewhat varied, traffic has slowed significantly. Buyers are taking more time to make a purchase decision, and many need to be convinced that now is the time to buy. Dude, now is not the time to buy. Let me just tell you that, okay? That's ridiculous. There is fear that sales prices have not hit bottom, or should I say, which has led to elevated cancellations. In these markets, we are focused on establishing pricing that generates new sales to offset cancellations. This has required us to work in many cases with backlog to prevent cancellations. In other words, it basically means going up to your existing buyers and you're like, please, hey, can we just give you like a preventive like $10,000 off, and here, sign this paper saying you're definitely buying the house, right? Like, in other words, there is panic going on here with significant base price reductions, aggressive mortgage buydowns. This is important because really what Lennar is telling you is, hey, like, when fear strikes, that's when these areas become category 3 markets. Because notice in category 1 and category 2, they really didn't say anything other than like, yeah, we have to give some more incentives, and then people are still buying. As soon as they mentioned the F word, which is fear, the fear that sales prices have not hit bottom, that's when the real price declines come, folks. And that is normal. That is also normal in terms of what you would expect in a bubble. First, you have the fear of missing out, which is people today still saying things like, oh, I may as well get in now before interest rates go up. Dumb, really, really dumb, whatever. That's exactly what happens right before a bubble pops. And then what do you end up having? You actually have fear that, oh no, prices are falling and I don't know when they're going to bottom. That usually lasts for a few years, that sort of fear. That fear becomes so entrenched that when it's time to buy, most people don't buy. But fortunately, I played this rodeo before of timing the bottom in the real estate market, and that is why now we're going to do so at scale. Go to househack.com to learn more about HouseHack. Now, there's also this talk about this professionalization of single-family dwellings. Still, though, only about 20% of home buyers are investors. But what they mention here is those competitors are actually slowing down, and their interest in single families has moderated. Again, another opportunity for HouseHack. I mean, this is like, I could not have asked for a better time to launch this startup. This is so phenomenal, and we're killing it with fundraising right now. We're over, well, I think we're over 17 or 18 million now. This is really, really good. And we're only in this like 2 weeks so far, which is insane that at the bottom of the stock market, we're still getting massive signups from investors. If we get to a number that's too high, we'll end up having to close the round because we're selling founder shares. So anyway, they do mention that here our incentives are about 4.5% right now. So that's sort of the total mix of how much they're incentivizing sales. That is an average across the country. And they are seeing inventory building up. So you do have really red flags here going forward. I think honestly, not only are the individual markets red flags, but you also have this massive red flag that when they tell you, yeah, instead of buying land to build new homes, we're just gonna buy back stock. And then in another part of the same investor report, they're like, yeah, you know, we thought about buying back stock, but we're actually just gonna pay down our debt. I mean, it just tells you what's coming. And if you don't believe the second largest home builder in the country, that real estate is hitting the wall, nobody can help you, except for maybe me, and you taking advantage of that amazing coupon code that expires at the end of the month, September 30th, linked down below. Make sure you get into those programs on building your wealth, and you can directly ask me questions in our Q&A live streams. Thank you so much. Goodbye.